our main focus point is about the bear market and whether it could be looming. Now, we've already had about a 10% drop in markets, right? We're about from the high at 6150, okay, on the S&P. And the low today, about 61 or 20 something. It was about 620 points, 625 points from the high. So we've had that correction, 10% now. Okay, but can it turn into a bear market? That's really the true question, right? Is this a blip in the radar, like the yen carry trade unwind of last summer? Or is this something more protracted like a 2022? Now, there are three catalysts here that we'll talk about. And the main one is inflation. We know that tariffs are inflationary. Simple as that. I've talked to many of other business owners and C-suite executives in my network, and anybody that deals with physical goods, they're having trouble. And it's going to cause them to raise their prices in order to maintain their margins so that they can continue to pay their workers. And they've instituted a hiring freeze. They were probably going to grow their staff anywhere from 4 to 6% this year. Now it's nothing. Okay. So clearly this is a problem for the broader economy, but once again, for inflation. And, he's already talked about, 20% on China. Now the Canada-Mexico ones most of it is exempt so far. Anything that was under USMCA, which is pretty much everything. So that one's been kind of held off a little bit. But reciprocal tariffs are likely on at some point. And so if all of his tariffs are put into effect, it would compromise 4.8% of US GDP. Now, by comparison, the Smoot-Hawley tariffs of 1930s, which everyone said worsened the Great Depression, that was 1.4% of GDP. Now, I do think it's a bit overblown that the Smoot-Hawley tariffs was the real culprit for the Great Depression. I think it definitely hurt, but there were a lot of other policy decisions that caused that to be much worse than it had to be. But nonetheless, this is clearly a potential catalyst for a Fed that maybe won't be as dovish. Now, the expectations for Fed rate cut are increasing though, but it's still only one rate cut between now and June. That's pretty much what's priced in. There's a little decent chance there might be two, but 1 to 2 over the next 3 meetings. And then it'll all be about, QT. Are they going to continue with QT? Most likely they'll wind it down. So there's likely a dovish pivot here. But the question is, how much can they really pivot if inflation does accelerate? Okay, so that's certainly the main catalyst. Now, second is how that feeds into consumer sentiment. Now, the Conference Board's Consumer Sentiment Index fell 10% in February. That's the steepest 1-month decline since August of 2021. And the lowest level since 2022, when the S&P was, near its lows after that bear market. So consumers are becoming more pessimistic about business conditions, less optimistic about their income. And we know consumers are not confident, even if they have the capacity to spend. I think that's something that remains is, there's still a lot of equity in homes, stock prices, while, they're down 10%, they're still way up from where they were just a few years ago. So there's still a lot of balance sheet wealth out there that consumers can fall back on. And oftentimes when they feel less pessimistic, it's more in words than action. So it's not always 100% correlated. So understand that. So while I think this matters, I think it matters far less than ultimately what inflation looks like and how that manifests in monetary and fiscal policy. Now, the third pillar here is valuation. Now, I think I want to highlight this because a lot of people will call that out. And I do think generally there's a lot of overvaluation in these tech equities that are trading at just very high cyclically adjusted P ratios. But there are still a lot of pockets of opportunity. Now, right now, the CAPE ratio is the second highest level ever outside of 2000, and similar levels as we were before the sell-off in 2022, late 2021. And so there's that catalyst that, when things usually what happens is when the market's going up, stocks are going up, people don't really care about valuation. It's when they start going down and they look up and they say, oh, you know what? Should this be trading at 45 times earnings? Probably not, right? There's not the justification. There's not that underlying dividend that it's paying or underlying, cash flows that it's creating that makes the valuations worthwhile. And so that's why I've said this for the past couple of weeks here, when people call about these big tech names and growth names that are down, 30, 40% from their high. What I always say is it can go much further. Usually they go down 60, 70, 80, sometimes 90% because the valuations are just so egregious. So valuation does matter, but it's also not a catalyst for a bear market. It's just something that can kind of be fuel to the fire when a bear market does occur, which is usually driven more by fiscal and monetary policy. And I love this quote. It's one of my favorites. Is what's the difference between a stock that's down 80% and 90%? Well, it's 50%, right? Stock that goes down 80% to get down 90% needs to go down to 50% more, right? So a lot of times it looks like the low, but can easily go down, right? 30% again, 40% again. It's not uncommon. And so that valuation can certainly build on itself. So that's where we are with this market. We're in technically we're at support. There are some dealer positioning things that means the pressure to the downside, at least for the short term, is probably going to abate a bit. But there are plenty of catalysts out there that can push this into a 2022 type market. But that also means there's a lot of opportunity. In 2022, it was mainly the big tech names that drove down the market, just like it was over the past couple of weeks. And there were plenty of industries that were up. I think energy, I believe that year was up. And so there are likely to be sectors, like there already are, that are up on the year, even though the broad indices are down. Look at consumer staples, healthcare. I'm seeing materials looking better, especially if the dollar goes down. A lot of the hard assets are going to continue to do well. So don't think that just because you have a bear market that you have to sell all your stocks. No, there are still great opportunities in the markets right now.